Good morning, young and happy people. Hi. My name is Diamond, and welcome to Long Distance Review. A place where we can have a discussion about any book, anytime, anywhere. Now, let me introduce my friend that already joined for this session. The first is Carlina. The second is Agung. Next is Ryan. Continue by Yusran. And the last is Ira. Today we will review one of the New York Times bestseller, One Up Wall Street by Peter Lynch. This book was published in 1989 and already sold for more than 1 million copies worldwide. Peter Lynch was born on January 19, 1944. He graduated from Boston College in 1965. After that he earned a Master of Business Administration from the Wharton School in 1968. Peter Lynch started as intern in Fidelity Magellan Investment on 1966, and being permanent employee in 1969. He became head of Fidelity Magellan for 13 years from 1977 until 1990. When he first took over, the firm only had $20 million as assets. But later, Lynch was successful in increasing it to $14 billion in 13 years. In this book review, our participant will answer questions about this book. So, prepare your notes and attention. Let's start and enjoy the show. How Peter Lynch became interested in stock investing.
When he was 11 years old, he did a part-time job as a caddy in a golf course. He often listened to golf player conversation about stock investment. This is the opportunity to learn about it. In 1963, he bought his first stock, the Fly Tiger Airlines stock. 2 years later, the stock became bigger so he can pay his own school tuition fee.
How has he become stock analyst?
When studied in Wharton, he became intense in Fidelity Investment House, that research and writing report about companies. After return from Korea in 1969 for military service, he rejoined Fidelity as a permanent employee.
Would you explain what are advices given by Peter Lynch in this book?
Okay, Peter Lynch in this book gives sounding advices about how to use what you already know to make money in the market. Invest in what you know. This goes on to be a central theme in the book. It leaves out the role of serious fundamental stock research. Investing without research is like playing poker and never looking at cards. People buy stock and they know nothing about it, means that's gambling, and it's not good. Never invest in a company that you never know.
So, if you cannot predict the future earnings, at least you can find out how the company plans to increase its earnings. Then you can check periodically to see if the plans are working out. Here are 5 basic ways to predict whether a company can increase its earnings. The first is reduce costs. The second is raise prices. The third is expand into new markets. Fourth, sell more of its product. Fifth is revitalize or close or otherwise dispose of losing operation. If you have an age, this is where it's going to be the most helpful. Always analyze the company's earning prospect, financial condition, and competitive position. You should understand the importance of earnings to eventual success or failure of any stocks.
What is the risk of stock compared to other investment?
Investing in stock appears to be scary, while bonds seems to be safe and secure. All investment is simply a gamble that you can manage. The riskier the fund, the better payoff.
What is 10-bagger?
When a stock earns a tenfold investment return, Wall Streeters call it a 10-bagger. The best place to find 10-bagger is to go shopping. Being a consumer gives you an intuition. because it exposes you to a successful company and their products. It will give you also an advantage to find a potential 10 beggars.
Talking about investing, what should we prepare before investing our money in the market?
Before you buy a share of anything in the market, try to pass the mirror test. There are 3 personal issues that ought to be addressed to ourselves. Issue number 1 is, do I own a house? Issue number 2 is, do I need the money? Issue number 3 is, do I have the personal qualities that will bring me success in stocks?
Do I own a house? Before you do invest anything in stock, you ought to consider to buying a house, since a house is one of good investment that almost everyone manages to make. Lynch believes that 99% of the time, a house will be a good moneymaker.
So, do I need the money? If you need the money in the short term, don't put that money into stocks. Stocks are relatively predictable over 10 or 20 years. Only invest what you can afford to lose without that loss having any effect on your daily life in the foreseeable future.
Do I have the personal qualities that will bring me success in stock? This is the most important question of all. The list of qualities ought to include patience, self-reliance, common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, an equal willingness to admit to mistakes, and the ability to ignore general panic.
Stock is an interesting investment. Is there a good strategy if we want to invest in stock?
There are too many investment gimmicks making the rounds, and with stock being so difficult to predict in the first place, there is no necessity for additional side bets that only serve as distractions. This doesn't mean that futures are completely useless, because they help farmers make profits too. But since the stock market is not a commodity that has a relation between the consumer and the producer, it's not possible to compare them.
What Peter Lynch said about type of company.
There are 6 categories. The first is slow growers. These large established companies have reached their stage in their life cycle, where they will grow only a bit faster than the general economy. And the second one is stalwarts. These established companies are a bit more dynamic, but still not very nimble. For example, like Coca-Cola and Bristol-Myers. And the third is fast growers. Generally speaking, these small companies are growing aggressively, sometimes about 25% per year. 1 or 2 good ones can make your portfolio a success. The fourth is cyclicals. These firm stock performance reflect regular up and down. Automobile manufacturers, airlines, tire, steel, and chemicals tend to be cyclical. The fifth is asset play. These companies sit on valuable assets, and you believe you understand something about them that Wall Street has missed. It's unlikely that anyone's been overlooked. And the last is turnaround. Turnarounds are candidates that demolish or depress. They are not slow growers because there is no growth. And they are not cyclicals because they will rise again. This has the potential to be a fatality. Usually, a cyclical company that has mismanagement will become a strong candidate to become turned around.
What kind of aspect or parameter that you think should considered in choosing stock?
Okay, basically there are several numbers that should be taken into account seriously. The first is the price per earning ratio, since the number could show the attractiveness of the stock price. If the growth rate of the company have lower than half of price per earning ratio, it could be categorized as a very negative or an attractive company. If the growth rate of the company have higher than twice of price per earning ratio, it could be categorized as a very positive or attractive company. The second, the cash position. It's always advisable to check the cash position and value of related business. The third is the debt factor. It's debt that determines which companies will survive and which will go bankrupt in a crisis. Young companies with heavy debts are always at risk.
What stock characteristics does Peter Lynch recommend investors to sell?
Peter Lynch explained about several stocks that perfect to buy and investors should avoid or keep an eye out for. If there's any stock that you need to avoid and when to sell, then you need to take a look at some of the hottest stocks in the hottest industry. Hot stocks can go up so fast, usually out of sight of any of the non-landmark of value, but since there's nothing but hope and thin air to support them, they fall just as quickly. The problem with the hot stock is that they have too many competitors too soon, and they go out of business even sooner.
Do we know the limits when we have to sell or buy?
It is not possible to predict time to buy stock because there is none. However, there are few exceptions during October to December. Many investors are more than happy to sell their stock to show their tax loss, and although it's ridiculous to be happy about failures, this period usually shows a sharp dip that gives you more opportunities to invest. If you don't know to invest or are short of money in this period, you can always wait for collapse, free falls, and hiccups that occur now and then.
So if there's no limits, is there any statement we can take as a reference?
There's no dearth of rumors in the stock market, and some are more ridiculous than the others. Even professionals fall prey to rumors, and you shouldn't be surprised if they tell you that stocks that have fallen too low already cannot go any lower. This is not only silly, but it can be dangerous if you hold on to your bad stock even when they hit rock bottom. Conversely, experts may also tell you that if a stock is too high, it cannot ride up any higher, that this is a myth too. Remember, there's no limit and stocks can go high as long as the company has changed to improve further.
How often do we need to check the company numbers?
Every few months, it's worthwhile to recheck the company's story. It's good to be able to know the latest value lines, the quarterly report, status of expected earnings. It will help us to know the growth of the company.
Related to the growth, do you know the phase of growth for a company?
Actually, there are three phases to a growth company's life. The first one is the startup phase or the riskiest phase. It is the phase when a company tries to establish family. Second, the rapid expansion phase or the safest phase. It is the phase when a company in the middle of expansion and getting most money. The last one is the mature phase or the most problematic. It is the phase when a company reaches its limit and finds a hard time to increase earnings.
What is the strategy to design a good portfolio?
When designing portfolio, we cannot expect the growth will be stable around 25 to 30%. There will be a time when we lose 2% or maybe 20%. Lynn suggests to divide the investment to some companies, but not too much, because the more companies you invest, the more companies you need to be analyzed. Spreading around the investment will minimize the risk. The portfolio may change, but do not quit from the market when you get the winner stock or when you get the loser stock. Try to rotate your investment and rechecking the fundamental aspect.
What are the 13 criteria to help identify potential multi-baggers?
The criteria are: it sounds dull or ridiculous, it does something dull or boring, it does something disagreeable, it is a spin-off, institutions do not own it and the analysts do not follow it, there are a lot of rumors about the company, there is something depressing about it, it is a no-growth industry, it has got a trademark or goodwill, people have to keep buying the products, it is a user of technology, and the insider are buying, and the last is the company is buying back shares.
Overall, what do you think about the book One Up on Wall Street by Peter Lynch?
Without a doubt, this is a must-read for the rookie investor, for all the stock market beginner investor, because it does a good job of conceptualizing the process of stock investing. Peter Lynch's thesis is simple, logical, and easily replicated. But don't forget, One Up on Wall Street was written in 1989. It has also lost some of its value over the last 20 years. Most of the content is still relevant, so it still serves as an adequate introductory book to new investors. But the book's concepts are no longer revolutionary, and there are newer books on the market with fresher content that convey the same ideas. Peter Lynch also describe about the stock market in the US, which quite different compared to Indonesia's stock market. So don't expect to find any great Indonesian stock tips from the investment master himself in there.
That's all for today. All the common investors can get great benefits by reading this book. Even if you don't agree with his philosophy, you should be able to draw some simple, yet important lessons from his advice on buying stocks. If you're an advanced investor savvy to the thrills and spills of the market, I still recommend this book. It might categorically change your investment strategy. Either way, the reader wins with this book. Thanks for watching our videos. See you on the next book.
Thanks for watching!
Thanks for watching.
Thank you for watching.
Thanks for watching.